the strategy we're going to be talking about today is called an inside day. And it really is one of the most consistent and, like I said, probably the least anxiety that you'll ever get. And that's why I say I really enjoy showing people this strategy, because it gives you so much room to learn, right? Because, like I said, for those of you especially that are new, you still need to learn how to manage your emotions, right? Very often being in a winning trade is as crazy emotionally as being in a losing trade. So you need to kind of figure out how to maintain that balance. So let me go show you what is the principle behind this. Now, in order to just clarify that, there's one more basic component that I'm just going to quickly address. Now, a lot of you use normal line charts when you do transactions, right? So you just basically want to see which direction the market's going. Then many of you would be quite familiar with something called a candlestick bar. Now, a candlestick bar is just basically a chart type. So what I'm trying to suggest is when you're in your charting platform, you can choose what type of charts you like, right? There's a whole different group of charts. Now, I like these charts, and I'll explain to you exactly what they consist of and why they are so useful. But my preference is for a straight bar chart because it becomes a little bit easier to see these things. But there's nothing wrong using a candlestick in this strategy as well, whichever one is most comfortable for you. So just quick basics before we get into the strategy. How a candlestick works, it basically shows you the entire day's transactions in one little stick. Now, basically, I'm going to explain them kind of both. I'm going to first explain this one, and then I'm going to come back to here. But the premise behind it is they both work on exactly the same principle. So a bar is typically for the period you set. So you can set daily trades, you can say hourly trades, 5-minute trades, or weekly trades. So if we use a daily bar, that bar will show the price activity for that trading day. So in this example, this little thing on the left means the market opened at this level, okay? Now this trading bar, the length of it says what was the trading range. So one can almost look at it like this and say the market opened up here, it dropped as low as this level, and then traded up all the way up to that level, and then settled at the end of the day and closed at this level. Okay, so it doesn't have to happen in that sequence. It's just a nice way to explain it. So it opens, traded as low as there, all the way up and closed there. Now, that's what the bar chart does, right? So when you look at a candlestick, it's exactly the same premise. They just make life a little bit easier for you. So when this movement was up, they usually have a color. So it'll either be green, or sometimes it's an empty one if so there's no color there if it's up, and when it's down it's black, as an example. So white and black. In my case here, I'm saying an up movement is a green bar and a down movement is a red candlestick. So you can see it still shows you the range of the day, but when you see a red one, you now have to know, oh, this market was moving or closed lower. So that's what I'm saying. For me personally, I just use a bar chart because your eye gets kind of used to seeing which direction or which side these things are. So just to complete the example, on a downward day, we would have seen a bar looking like this. The market opened there, traded maybe as high as all the way up there, then all the way down to the lowest level it possibly traded, and it closed at that level. All right, so that's the basic premise that you need to understand in order to understand this strategy. So you need to just kind of get a little bit familiar with how this opening and this closing works and that line. Okay, now let me go show you why I'm saying that. So when we look at an inside day, what an inside day does, it's actually a phenomenal little tool. So remember I said each one of these days is a single trading day. So in this example, market range went from there to there, and this was coincidentally an up day. I want to just make the point that we are completely indifferent to whether this was an up day or a down day. We're also completely indifferent to whether this was an up day or down day. What we're looking for is a situation where today's trading range, this entire trading range, sits in between, sorry, give me one quick second. This entire trading range sits in between yesterday's trading range. So let me explain to you that in context. every single bar is price action for the day. So in essence, the day before, the market traded all the way up there and all the way down here, and it closed lower, right? So we can say the bulls and the bears had at it. They fought throughout the day. The bulls tried to push it up there. They made that high, but then the sellers came in and they pushed it all the way lower. But here the buyers came back in and they pushed it all the way up there. So this is kind of the story of the day. It tells us what happened on that day. Now here comes the next day. Now what happens in a case like this, the market tried its absolute best. So this epic fight that exists between the bulls and the bears, the market opened up, but look, the bears tried to push it lower and they came buying. So the bulls came in and said, no, you're not pushing this lower. We're actually running this up. And they tried their absolute very best, but they also couldn't even get to yesterday's range, right? So their maximum, then the sellers came in and said, no, you're not taking this one higher than here. And they started selling. And that fight went on like that the whole day, and it stopped. It closed at that level. So what we're interested in, like I said, we're not worried if this is an up or a down day. We're not worried if this is an up or a down day. What we're looking for, the strategy does just the following. Was there a day where the total trading action sat within the range of the previous day? Now, what makes this really, really nice is, remember I said we're looking for a low maintenance strategy. So this strategy you're really only going to look at the end of the day, right? So when the market is closed or close to when it's closing, you're going to say, okay, well, that is probably going to settle somewhere here. So we didn't make that range for yesterday. And what makes the strategy then very effective, it kind of gives you all the tools to know exactly what you're going to be doing tomorrow. Now, remember, again, we're not necessarily making massive trades here. We're not looking for massive trades. What we're doing is we're playing human behavior. Now, what I'm suggesting is, statistically, it does happen. In fact, it happens relatively often, but not significantly often that it messes with the strategy. But what it means is, most of the time, when a day like this happens, the next trading day, one of the two forces win. So what I'm suggesting is, when both fought so hard and they couldn't really go anywhere, on the next day, chances are someone's going to go out of this range, right? So now we're looking just at this one's range, and I'll show you when we get there, so don't worry if it's a little bit unclear. We'll get to that point. I'm just saying the chances of another day like this happening is relatively remote. They do occur, but they're relatively remote. So typically what we'll expect tomorrow is someone's going to break this range. And this is the simplicity of the strategy. We're not looking to predict the market. We're not looking to be right. All we're looking at is to say, whoever wins, we're going to take that ride with them. So we want to just enjoy the ride of that fight. So let's go have a look. So let's pretend that this strategy, the day's range. Now remember, so if I can remind you, we're actually sitting on this day. So we're evaluating this day. So we're looking at what happened yesterday, and we say, well, today we're sitting in this range. So what we're looking for now is, what are we going to do tomorrow, right? So that's the premise behind it. And how this works is, we're going to place orders. Remember, all we're saying is whoever's going to win the battle, we want to enjoy the ride. So if the market breaks to the top tomorrow, we want to be a buyer, right? So we're going to be a buyer at 109 and a little bit of a spread. I'll explain to you that now. Or alternatively, we are completely indifferent. It could also go the other way. If the sellers of the day wins, we want to be a seller on the way down because we want to enjoy that ride. So in this case, what we will use is, we will use the bar high as the order level. So we're saying if the market goes through there, we want to be a buyer. Now you see what I said. In our case, the market order is going to be a stop buy order. So we're not going to put a limit order in place, because if this is where the market closed, a limit order would want you to buy on the market going lower. What we're saying is, as the market breaks out, we want to go long. So that type of order is called a stop buy order. So what we're going to be doing is, we're going to put a stop buy order just slightly above 109. Now, how slightly above? That little spread there what we're saying is just whatever the bid ask is. Now, say, for example, if you do currency, that's relatively small, right? That's like 1 or 2 pips at most. But what you want to do is you just want to make sure it clears that hurdle for you to start buying and then going up. But if you did equities as an example, or something like the dollar rand, that might have a 20 cents range or a 50 cent spread or whatever the case may be. We just want to make sure that we put that spread. So whatever the spread on the bid and the ask is, so in our example for this currency, it probably is going to be 1 or 2 points. So we're putting an order in to say if this market breaks that level at 109.02, we're going to do a stop entry to buy. Because remember what we're saying is that one there, if it breaks out, we're just going to ride that momentum. And guess what? At the same point, so this strategy requires you to put in 2 orders, right? Because we're saying we don't know which one's going to break. We just want to ride the one that's going to break. So in this example, again, with the market, the low of that bar being 108.90, we'll put our stop sell order, that's an entry order, say 2 pips below there, right? So now we have the entry points for both directions. Because remember, tomorrow the market's going to open up and now it's going to trade hopefully out of that range. Okay, so now let's look what happens. This is now the next day. So we evaluated that trade. We've placed our orders in the system and now we can go to work, right? We've done what we need to do. We don't really need to monitor this trade consistently throughout the day. For the current system, we just need to do 1 check throughout the day to see if we're in a transaction. And I'll explain that now to you. So effectively what happens is on the next day, market's going to open up. And if it breaks that transaction or that order level, that top range, chances are it will actually continue. Because remember I said what we're doing is we're just following whoever won yesterday's battle. So yesterday nobody could make their minds up. Today the bulls are at it and they're running it higher. So we're actually just taking that ride with them. Like I said, we're not trying to outperform or predict the market. In this case, we're going to go and just that order is going to be triggered. And the simple part of this is we're not going to stop and worry what we're going to do and how are we going to get out of this trade and when do we get out of trade. The simple nature of this trade is let's give them as much room as possible. So we'll only close this transaction at the end of the trading day, right? And we'll talk about some of that timing issues now. So basically we allow them to fight as long as they can, and just wherever the market is, at the end of the day, we're going to close our position. And the reason we close is we're not in this trade for a specific view, right? We're not catching a trend. We're not catching a real breakout per se. We don't necessarily know what's going to happen tomorrow, and we don't care what's happening tomorrow. We just wanted today's range, right? So what we want to do is just bank that little bit of profit. Also, it could have gone the other way. So the market on the next day could have gone lower, right? So that's why we put both those orders in. So on the way down, it triggers our order level. And again, we're going to just let the market run as far as it can and close that position tomorrow.